Hi friends, welcome to my channel. In this lecture, which is lecture 3 of accounting basics, we are going to study journal entries, the base of accounting records, concepts and method of passing journal entries using debit credit rules. Please subscribe my channel so you would never miss my upcoming videos. First of all, we would look at what is accounting cycle. It is the sequence of accounting procedures used to record, classify, and summarize accounting information in financial reports at regular intervals. It starts with the initial recording of business transactions, which is journal entry, and concludes at financial statements. The term cycle in the accounting cycle, it indicates that these procedures must be repeated continuously to enable business to prepare new and updated financial statements for each accounting period. Look at the diagram of accounting cycle in the very first step, which is journalizing or recording the transactions. In the next step, we post each journal entry to the appropriate ledger accounts. In the third step, we prepare a trial balance, and in fourth step, we make end of year adjustments. After that, we prepare adjusted trial balance, and in the sixth step, we prepare financial statements, which includes income statement, balance sheets, etc. In the seventh step, we journalize and post closing entries, and in the last, we prepare after closing trial balance. And after that, the whole process continues, and it is accounting cycle. So now, what is journal entry? Journal entry is the most important thing in whole accounting. It is the very first step and basis of the whole accounting cycle. Learning journal entry has same value in accounting as of learning counting in mathematics. It is basically the method by which we initially record the business transactions in the accounting record, which is journal, and is later transferred to the appropriate accounts, journal ledger. Business transactions involves exchange of goods or services for cash, which is also called monetary transactions. For example, sale of purchase, sale return, or purchase return. So now, what is double entry system? It is the system which is followed in recording journal entry because there is always two effects of each journal entry, and the both of effects are recorded on different sides. The two sides of journal entry are called debit, which is denoted as DR or debtor's side, and other side is called credit, which is written as CR dot, or it is creditor's side. So now, what is meant by debit? It is basically increase in the assets, expenses, or drawings. Assets, which includes cash, bank, or debtors. Expenses, which include utility bills, office rent, etc. Drawings, which is decrease in capital. So if there is increase in assets or expenses or drawings, it is a debit. Or if there is decrease in liabilities, capital, or sales revenue, that will also be a debit. Liabilities could include creditors, notes payables, etc. And capital is owner's equity, and sales revenue, it is income of the business. So if liability, capital, or sale is decreasing, it is a debit. So now, what is meant by credit? Credit is the vice versa of the debit. So in debit, assets, expenses, or drawings were increasing, and liabilities, capital, or sales were decreasing. So in credit, there is increase in liabilities, capital, or sales, and decrease in assets or expenses or drawings. If any of the thing happens out of this, it is a credit. So now, journal entries concepts. Basic concept behind journal entry is give and take, because whenever a company, we are considering ourselves as a company, we give something, product or service to somebody, we also get from him something in return of equal value. The both effects go side by side. There are basically two types of transactions. One is cash transactions, for which we receive or pay cash on the spot, and other one is credit transactions, for which we promise to pay or get promise to receive cash in future. There are basically two types of transactions: cash transactions or credit transactions. Cash transactions, for which we receive or pay cash on the spot. It is cash. It could be cash sale or cash purchase. Cash sale is when we sold goods on cash, or cash purchase is when we purchase goods on cash. They both are cash transactions. And in credit transaction, there could be a credit sale or credit purchase. Credit sale is when we sold goods on credit, or credit purchase is when we receive goods on credit. They both are credit transaction. So now we would further look at these concepts with the help of examples. In examples of selling, look at the first example. It is cash transaction or cash sale example. A fan manufacturing company sold a fan to a customer of worth rupees 5,000 and received rupees 5,000 in return from him. So company has sold given fan and received cash in return from the customer. It is basically sale of rupees 5,000 by the company to the cash customer. So it is a cash transaction of rupees 5,000. Next example, we are looking at a credit transaction of sale. A trading company sold some goods to Mr. Ali of worth rupees 12,000 and Mr. Ali promised to give money against goods after 1 month. So company has sold goods and received promise in return from Mr. Ali, which is his credit customer, to pay after 2 weeks. It is basically sale of rupees 12,000 by the company to a credit customer. So it is a credit transaction. So now look at the examples of purchasing. First of all, cash transaction or cash purchase. A shopkeeper purchased cold drinks from his supplier of worth rupees 12,000 and has provided rupees 12,000 in return to him. It is basically purchase of rupees 12,000 by the shopkeeper from the supplier. Look at the example of credit purchases. A production company purchased raw material from their supplier of worth rupees 14,000 and promised to provide rupees 14,000 in return to the supplier after 1 month. It is basically credit purchase of rupees 14,000 by the company from the supplier. Look at this table, how we would write these transactions. In first example, which is cash sale, we will write in debit what is received by the business. So in example 1, the business received cash or bank of rupees 5,000, and in description we will write cash being received. Now look at the credit side. We would write what is provided by the business. So what is provided by the business in example 1? It was a sale of fan of worth rupees 5,000. So in description we would write fan or goods being sold. Look at example 2, which is a credit sale. In debit we will write account receivables or debtors, because we are receiving a promise of rupees 12,000, and we would write in description account receivables being increased. In credit, we would write sale because goods are being sold of rupees 12,000. In example 3, which is of cash purchases, we would write in debit what we have received. We have received cold drinks, which is a purchase for our company of worth rupees 12,000, and we will write in description goods being purchased. In credit, we would write cash or bank because we are providing cash to our supplier of worth rupees 12,000, cash being decreased. Now in example 4, it is of credit purchases. In debit, we would write purchases as goods being received of worth rupees 14,000, and in credit we would write accounts payables or creditors of worth rupees 14,000 because account payable is being increased. So now look at the examples of discount. What if a trading company sold some goods to Mr. Ali of worth rupees 12,000, and Mr. Ali promised to give cash against goods after 1 month. So company has sold goods and received promise in return from Mr. Ali to pay after 2 weeks. It is basically sale of rupees 12,000 by the company to credit customer. So now, if on the time of receiving cash, company allowed Mr. Ali to pay only 11,500 in place of the whole amount, which was rupees 12,000. So what is it? It is discount allowed or expense of rupees 5,000 by the company. It is discount allowed, which is expense to the company. How would we write it? In the step 1, as we have written earlier, debit is account receivable and credit is sale of 12,000. Step 2, when we were receiving the whole cash, it would have in debit cash receiving 12,000, and in credit account receivable or debtors 12,000, because account receivables would be decreased and cash is being increased. Now look at if our company allowed discount of rupees 500 to the debtor. So in debit we would write in cash 11,500, and the other 500 we would write discount allowed, which is expense, and when expense increase, it is written in debit. Look at the debit credit rules. In credit, we would write account receivables whole amount, which is rupees 12,000. Look at these both sides. These both sides must be equal. So now look at the example of discount received. A production company purchased raw material from their supplier, which could be XYZ, for of worth rupees 14,000 and promised to provide rupees 14,000 cash in return to the supplier after 1 month. It is basically credit purchase of rupees 14,000 by the company from the supplier. Now, if when our company was providing cash, our supplier allowed us to pay only rupees 13,500 in place of whole amount, which was rupees 14,000. So now we are receiving discount of rupees 500 and it is income of the company. Look at the table now. In the very first step, it was a purchase, debit was increased by 14,000, and in credit we have written accounts payable of rupees 14,000. When we were giving the whole cash of 14,000, in debit we would have written accounts payables or creditors of rupees 14,000, and in credit we would write cash rupees 14,000. Now if we receive discount of rupees 500, we would write in debit accounts payable of 14,000, and in credit we would write cash of worth rupees 13,500, and the balance 500 we would write in discount received. As I have told earlier, this discount received is income of the company, and income of the company is written in credit side when it is increased. Please subscribe to my channel, click on notifications bell icon for updates, and share the video. Thank you.